In this video, we are going to see a comprehensive problem with all adjustments on admission of a partner. I have already uploaded two separate videos with necessary information. So now we are going to see how to solve this problem. Look at the problem. A and B are partners sharing profit and loss in the ratio of 3:1. So this is the old ratio. Their balance sheet stood as under on 31st March 2015. So balance sheet is given, that is old balance sheet is given. All assets are there and liabilities are there. Look at the balance sheet asset side. Stock 10,000, prepaid insurance 1,000, debtors 8,000 minus provision for doubtful debts 500, balance 7,500, cash 8,500, machinery 22,000, buildings 30,000, furniture 8,000, profit and loss account 10,000. It is a loss. Goodwill 10,000. Look at the liability side. A's capital 30,000, B's capital 20,000, total capital 50,000, general reserve 12,000, creditors 40,000, outstanding salary 5,000. So total 1,07,000, 1,07,000. Look at the adjustments. C is admitted as a new partner introducing a capital of rupees 25,000 for his 1/4 share in future profit. So new partner share is 1/4. Following revaluations are made. So the first one, stock to be depreciated by 5%. Furniture be depreciated by 10%. Buildings be revalued at 40,000. So look at the balance sheet value. Building value is 30,000 is there. The revised value is 40,000. So it's a appreciation. 10,000 increased. Okay, whereas stock and furnitures are depreciated, but building value is appreciated by 10,000. Okay, fourth adjustment. The provision for doubtful debt should be increased to 1,000. So look at the asset side. Provision is already there. How much? Look at the balance sheet. Debtors 8,000 less provision for doubtful debts 500. So already 500 is there. Now this liability is increased to 1,000 rupees. So any item which decrease asset is called, it's a liability. So all provisions are liabilities. Okay, so provision for doubtful debts 500 is there. Now it has been increased to 1,000. So excess amount is 500 rupees. Just find the difference. Old value is 500, revised value is 1,000. So difference between these two is 500. The provision for doubtful debt should be increased to 1,000, from 500 to 1,000. So excess 500 increased. Next, goodwill was valued at 18,000. Just see the balance sheet. Already goodwill appeared in the balance sheet. Look at the balance sheet asset side. Goodwill is there at 10,000. Now the revised value is 18,000. So this one is understated. The revised value is more than the book value. So the balance sheet value is less than the revised value, which means understated. So you have to find the difference. The excess amount will be transferred to old partner's capital account. Look at the next adjustment. Creditors include rupees 5,000 no longer payable, and this sum was to be written off. So creditors 5,000 included. Look at the balance sheet. Look at the balance sheet liability side. Creditors 40,000 is there. In that 40,000, 5,000 which is already included in this 40,000 no longer payable. So that particular amount is written off. So it is a gain. So any liability decrease, it's a gain for the partner. Okay, look at the next adjustment. Investment of rupees 10,000 be brought into account. That is unrecorded asset. Now they are going to record. So it is also gain. See the first adjustment. Stock be depreciated. So any asset decrease, it's a loss. Furniture depreciated by 10%. It is also loss item. Building be revalued at 40,000. So old value is 30,000. Revised value is 40,000. 10,000 increased. It is a profit item. Provision for doubtful debt, it's a liability. So liability increased from 500 to 1,000. So it is a loss item. Goodwill be valued at 18. So this will be the excess amount will be transferred to old partner's capital account. You need not record this under revaluation. And creditors include 5,000. So here they are going to write off the liability. Okay, so it is a gain for the partner. So profit item. Investment of 10,000 brought into account. So new asset they are going to enter in the revaluation account. So it is a gain for the partner. So according to this you have to pass journal entry, and they ask you to prepare revaluation account, capital account and balance sheet after admission. First, I am going to make journal entries for the adjustment. Look at the problem. The first one is C is admitted as a new partner introducing a capital of rupees 25,000. So what is the entry for this transaction? Cash account data to C's capital account. First entry, cash account data to C's capital account. If they have bank account, then you can write bank account data to C's capital account. So in this problem, there is no bank balance. So straight away you can write cash account data to C's capital account. How much? 25,000. Narration. Cash brought in by C as his capital 25,000. Look at the next adjustment. We have made the journal entry for C's capital. Okay, now see the other adjustments. Following revaluations are made. So the first one, stock be depreciated by 5%. So stock is an asset now. So when the asset decrease, what is the entry? Revaluation account data to stock account. So look at the balance sheet. Stock 10,000, 5% decrease now. So 5% on 10,000 is 500. Entry. Revaluation account data to stock account. So when the value of asset decrease, just credit asset account. So asset always showing debit balance. When the value of asset decrease, just enter credit side. So entry for the transaction is revaluation account data to stock account. How much? 500. Narration. Stock be depreciated at 5%. Look at the next adjustment. Furniture be depreciated by 10%. Look at the balance sheet. Furniture value how much? 8,000 is there. Now the furniture be depreciated by 10%. So 10% on 8,000 is 800. Entry for the transaction is revaluation account data to furniture account. Narration. Furniture be depreciated at 10%. %10 on 8,800. Next adjustment. Building be revalued at 40,000. So look at the balance sheet. Building value how much? 30,000 is there. Now the revised value is 40,000. 10,000 increased. So entry for the transaction is building account data to revaluation account. So building is an asset. So all assets are debit balance. When the asset value increase, again you have to debit the particular asset. Building account data to revaluation account. How much? Difference 10,000. Old value 30,000, revised value 40,000. Difference 10,000. Narration. Building value increased. Look at the fourth adjustment. The provision for doubtful debt should be increased to 1,000. Look at the balance sheet. So already provision for doubtful debts is there. How much? 500. Now it has been increased to 1000. So what is the difference? 500 difference. So any provisions, it's a liability, no. So when the liability increase, it is a loss for the partner. So what is the entry for the transaction? Revaluation account data to provision for doubtful debts. Entry revaluation account data to provision for doubtful debts. How much? 500. That is the difference value. So provision for doubtful debts increased to 1000. So old value is 500. It has been increased to 1000. Difference amount is 500. Narration. Increase in the value of liability. Increase in the value of liability. So provision for doubtful debts, it's a liability. Next item, goodwill was valued at 18,000. In the balance sheet, 10,000 is there. So it is understated. Okay, the appeared value is 10,000 but the revised value is 18,000. So which means understated. Now find the difference. So difference between book value and revised value is 8,000. That 8,000 will be transferred to old partners capital account according to their old profit sharing ratio. So entry for the transaction is goodwill account data to A's capital and B's capital account. $8,000. So 8,000 will be shared among old partners according to their old profit sharing ratio. Look at the problem. A and B are partners sharing profit and loss in the ratio of 3:1. This is the old profit sharing ratio of A and B. That is 3:1. 3/4, 1/4. For A, 8,000 into 3/4. For B, 8,000 into 1/4. 6,000 and 2,000. For A, 6,000. For B, 2,000. For A, 6,000. For B, 2,000. Narration for the above transaction. Increase in the value of goodwill transferred to old partners capital account in their old ratio. Next adjustment. Creditors include 5,000 no longer payable and this sum was to be written off. So creditor is a liability. Now they are going to written off. So it is a gain for the partner. Any liabilities which decrease, it will lead to gain for the partner. Entry for the transaction is creditors account data to revaluation account. Entry creditors account data to revaluation account. How much? 5,000. Narration. Decrease the value of liability. Next adjustment. Investment of rupees 10,000 be brought into account. That is unrecorded asset. Now they are going to record. So it is a gain for the partner. Okay, because it is an asset. No, so investment is an asset. So when we enter asset, it's a gain for the partnership firm. So entry for the transaction is investment account data to revaluation account. Investment account data to revaluation account. $10,000. Narration. Investment brought into account. After making the necessary journal entries for all the adjustment, now look at the balance sheet and find if there is any undistributed profit and accumulated reserve. If there is any undistributed profit or loss or accumulated reserve, that will be transferred to old partners capital account according to their old profit sharing ratio. Okay, look at the asset side. Stock, insurance, debtors, cash, machinery, buildings, furniture, profit and loss. So it is a loss. If you find any profit and loss under asset side, it is a loss. Okay, this will be transferred to old partners capital account according to their old profit sharing ratio. Okay, at the same time, look at the liability side. Capital is there, general reserve. So general reserve, so any reserve which is belong to old partner. Okay, this will be transferred to old partners capital account according to their old ratio. This is a gain and this one is loss. So entry for the transaction is for the loss. Entry for transfer of undistributed loss. So entry for the transaction is old partners capital account data to profit and loss. So entry A's capital account, A's capital account data, B's capital account data to profit and loss. It is a loss. Okay. So narration, transfer of undistributed loss. Okay, the undistributed loss transferred to old partners capital account according to their old profit sharing ratio. How much? 10,000 is there now. So according to the ratio, 10,000 into 3 by 4, 10,000 into 1 by 4. For A, 10,000 into 3 by 4. For B, 10,000 into 1 by 4. 7,500. For A, 7,500. For B, 2,500. For A, 7,500. For B, 2,500. In the same way, transfer of undistributed reserve. That is general reserve is there, no? See the balance sheet liability side. General reserve 12,000. So this will be transferred to old partners capital account. But it is a gain. So entry for the transaction is general reserve account data to old partners capital account. For loss, old partners capital account data to profit and loss. Entry general reserve account data to A's capital account and B's capital account. To B's capital account. How much? 12,000 is there now. So their old profit sharing ratio is 3:1. For A, 12,000 into 3 by 4. For B, 12,000 into 1 by 4. For A, 9,000. For B, 3,000. For A, 9,000. For B, 3,000. Narration, transfer of general reserve to old partners capital account. Transfer of undistributed reserve. So far we have passed journal entries for the above transactions. Now we need to prepare revaluation account. So from the journal entry you can easily prepare revaluation account. Okay, after preparing the revaluation account, you will be getting either profit on revaluation or loss on revaluation. Okay, that will be transferred to partners capital account. That is old partners capital account. And after preparing the revaluation account only, we can able to prepare capital account and balance sheet. Now let us see the revaluation account. From the journal entry, now we are going to prepare revaluation account. Look at each and every entry. Wherever you find revaluation, enter those items under debit side or credit side according to the transaction. Look at the first entry, cash account data to capital account. This will be recorded in capital account. Second entry, revaluation account data to stock. This will be shown under revaluation account. So revaluation account data to stock, no. Enter stock under debit side of revaluation account. Under revaluation account, debit side to stock, how much? 500. Next, third entry, revaluation account data to furniture. Okay, enter furniture under debit side of revaluation account. To furniture 800. Next transaction, buildings account data to revaluation account. So building is debit side, revaluation is credit side, no. So enter building under credit side of revaluation account. Buy buildings. Buy buildings 10,000. Next entry, revaluation account data to provision for doubtful debts. So enter this item under debit side of revaluation account. To provision for doubtful debts. How much? 500. Next entry, goodwill account data to old partners capital account. This will be shown under capital account. Next, creditors account data to revaluation. So enter creditors under credit side of revaluation account. Buy creditors. How much? 5,000. Next entry, investment account data to revaluation account. So enter investment under credit side of revaluation account. Buy investment. How much? 10,000. Okay, next entry, old partners capital to P&L account. This will be transferred to capital account. Then general reserve to old partners capital account. This will be shown under capital account. So that's all. So with this you can close the revaluation account in order to find out profit on revaluation or loss on revaluation. Get the total. Just find which side is highest value. Debit side we have got 1,800, but credit side 25,000. So this amount is greater than this amount. So enter higher value, that is 25,000. Enter the same value under debit side also, 25,000. So here you will be getting balancing figure. This balancing figure is called profit on revaluation of assets and liabilities. So this will be transferred to old partners capital account according to their old profit sharing ratio. So 25,000 minus 1,800 is equal to 23,200. To profit on revaluation transfer to capital account. So A is capital and B's capital account. Just divide 23,200 according to their old profit sharing ratio. For A, 23,200 into 3 by 4. For B, 23,200 into 1 by 4. For A, 17,400. For B, 5,800. Total 23,200. For A, 17,400. For B, 5,800. Total 23,200. This is the profit on revaluation. Now you have to make journal entry for this transaction. Entry for profit on revaluation is revaluation account data to A's capital to B's capital. Okay, next entry, that is transfer of revaluation profit to old partners capital account. Entry, revaluation account data to A's capital and B's capital. Narration, profit on revaluation transfer to old partners capital account. How much? 23,200. For A, 17,400. For B, 5,800. So far we have passed journal entries and we have prepared revaluation account. Now we need to prepare capital account. So after preparing the revaluation account only, you can able to prepare capital account. Look at the capital account format. Debit side particulars A, B, C. Credit side also particulars A, B, C. We need to have a separate column for each and every partners. So first you have to start with the opening balance. So capital is a liability, no. So liability is always showing credit balance. So opening balance, that is by balance brought down, that is opening balance. This you can find from the old balance sheet liability side. Look at the balance sheet. Liability side, A's capital 30,000, B's capital 20,000. This is the opening balance for A and B. For A 30,000, for B 20,000, for C no balance. Okay, now just see all the journal entries. Wherever you find any capital, that will be transferred to capital account. Look at the first entry. Cash account data to C's capital. So enter cash in C's capital account. So cash account data to C's capital no. So enter cash under credit side of capital account. Capital account by cash. See how much he brought? 25,000 C's capital. So entry is cash account data to C's capital. By cash 25,000. See the next entry. This we have entered in revaluation account. This is also entered in revaluation. Here also revaluation is there. Here also revaluation is there. See goodwill, that is the understated 8,000 rupees. That 8,000 is transferred to old partners capital account. So this will be recorded in partners capital account. So goodwill, enter goodwill under capital account by goodwill. Credit side by goodwill. How much? For A 6,000, for B 2,000. For A 6,000, for B 2,000. Look at the next entry. Creditors to revaluation. This we have entered in revaluation. This is also entered in revaluation. And this is undistributed profit and loss. Here we have got loss no. This loss is transferred to A's capital and B's capital. So this will be recorded in the capital account. So A's capital, B's capital account data to profit and loss. So this will be shown under debit side of capital account. So capital account to profit and loss. For A 7,500. For B 2,500. Look at the next entry. General reserve account data to A's capital to B's capital. So this will be shown under credit side of partners capital account. For A 9,000, for B 3,000. So capital account credit side by general reserve. For A 9,000, for B 3,000. See the last journal entry, that is a revaluation account. We have got profit no. That profit is transferred to partners capital account. So entry revaluation account data to old partners capital account. So this will be recorded under credit side of partners capital account. For A 17,400, for B 5,800. Capital account credit side by revaluation account within bracket profit. How much for A? For A 17,400, for B 5,800. That's all. We have entered all the transaction in the capital account. Now we need to get the total and find the closing balance. For A 30,000 plus 6,000 plus 9,000 plus 17,400, total 62,400. For B 20,000 plus 2,000 plus 3,000 plus 5,800, total 30,800. For C 25,000. Enter the same value under debit side also. For A 62,400, for B 30,800, for C 25,000. Now you can get the balancing figure. To balance carry down. For A 62,400 minus 7,500, balance 54,900. For B 30,800 minus 2,500, balance 28,300. For C no value, so put entire amount as balance. So this is the closing balance. For A 54,900, for B 28,300, for C 25,000. To balance carry down, this will be transferred to opposite side. By balance brought down. For A 54,900, for B 28,300, for C 25,000. While you prepare the new balance sheet, under liability side you have to show A's capital 54,900, B's capital 28,300 and C's capital 25,000. Now let us see the balance sheet. Now we need to prepare new balance sheet after admission of a new partner. Okay, when you prepare the balance sheet, just refer the old balance sheet and find the revised value and record the revised value of assets and liabilities. Look at the old balance sheet. Stock 10,000. Look at the adjustment. Stock be depreciated by 5%. No. First item, stock 10,000 minus 5% depreciation 500. Balance enter in the outer column. This is the revised value. Next item, prepaid insurance. So no adjustments regarding this. So you can enter the same value as it is. Prepaid insurance 1,000. Debtors 8,000 minus provision for doubtful debts 500. Look at the adjustment. Look at the fourth adjustment. The provision for doubtful debts should be increased to 1,000. So already 500 is there. Now it has been increased to 1,000. Debtors 8,000 minus provision for doubtful debts 1,000. From 500 to 1,000. So excess 500. Total 1,000. No. So 8,000 minus 1,000, 7,000. Next item, cash 8,500 and new partner brought 25,000 cash as capital. No, that will be added along with this cash balance. So 8,500 plus 25,000. Look at the adjustment. C is admitted as a new partner introducing a capital of rupees 25,000. So this will be added along with the cash balance. Cash 8,500 plus C's capital 25,000. Okay, total 33,500. Next item, machinery 22,000. So nothing is given regarding machinery. You can enter the same value as it is. Machinery 22,000. Next item, buildings 30,000. Look at the adjustment. Look at the third adjustment. Building be revalued at 40,000. So old value is 30,000. Revised value is 40,000. 10,000 increased. Buildings old value 30,000 plus appreciation 10,000. So revised value is 40,000. Next, furniture 8,000. Look at the second adjustment. Furniture be depreciated by 10%. Furniture 8,000 minus 10% depreciation 800. Balance 7,200. Next one, profit and loss. This is the loss. This already we have transferred to old partner's capital account. Now you need not write this item. Then goodwill. Goodwill old value is 10,000 but the revised value is, look at the adjustment. Look at the fifth adjustment. Goodwill was valued at 18,000. So enter the revised value 18,000 under asset side of new balance sheet. Goodwill 18,000. Goodwill old value is 10,000. The revised value is 18,000. So you have to enter only the revised value, that is 18,000. Just check if there is any unrecorded asset which is given in the adjustment. Look at the last adjustment. Investment of rupees 10,000 be brought into account. So this is an unrecorded asset which is not recorded in the old balance sheet. Now they are brought into account. So this will be shown under asset side of new balance sheet. Asset side, investment. How much? 10,000. Okay, all assets are over. Now look at the liability side. Look at the liability side. The first item is capital. So A's capital, B's capital is there. This is the opening capital. But you have to take the balance from the capital account. Look at the capital account. closing capital how much? For A 54,900, for B 28,300, for C 25,000. So you have to record the closing capital under liability side of new balance sheet. Capital for A 54,900, for B 28,300, for C 25,000. Enter the total under outer column 1,08,200. Look at the old balance sheet. General reserve 12,000. So this is the undistributed reserve. This already transferred to partners capital account. Now you need not show in the new balance sheet. Okay. Then creditors 40,000 is there. Look at the adjustment. Look at the sixth adjustment. Creditors include 5,000 no longer payable, and this sum was to be written off. So subtract 5,000 from the total creditors. Creditors how much? 40,000 minus 5,000. Creditors 40,000 minus written off 5,000. Balance enter in the outer column 35,000. Next item. Outstanding salaries 5,000. So nothing is given regarding this transaction. So straight away you can write this amount as it is. Outstanding salary how much? 5,000. That's all. Now we can get the total. First take the total under liability side. 1,08,200 plus 35,000 plus 5,000. Total 1,48,200. The same way, asset side 9,500 plus 1,000 plus 7,000 plus 33,500 plus 22,000 plus 40,000 plus 7,200 plus 18,000 plus 10,000 is equal to 1,48,200. This is the way to prepare partnership accounts at the time of admitting a new partner. Hope you all understood this concept. Thank you.